What is going on, fellow investors? I thought I'd talk about three individual stocks that look at a very good valuation at the moment. I think the valuation is very compelling. I think these stocks have been massively oversold. And I do think the growth upside could be quite significant on all of these stocks, given how good the valuation currently looks. As always, no financial advice is given. It's just my thoughts and opinions. And one of my most recent entries is this stock, funny enough, which is AppLovin. AppLovin is an incredible business, in my opinion, worth over $100 billion, one of the biggest software advertisement platform providers out there. And they had a relatively good earnings in Q2, but they did regrettably miss on their revenue. They only missed by 1%. And rather than just miss by 1% and have a 10, 15 odd percent sell-off of a share price, which is what is usually warranted when businesses miss on their earnings on earnings reports, the market penalised this business by wiping off over $36 billion of market cap simply because this business lost out on $20 million from what analysts were expecting in regards with revenue. EPS was solid, guidance was solid, management's outlook on the business was solid, the conference call was good. We've got a PEG ratio of 0.59, we've got a price to earnings of 23, a forward to earnings of 17. We've got share buybacks in the billions being announced each year where management is buying back. We've got over $4.5 billion of free available dispensable cash in which the business has. The business looks good. Fundamentally, financially, the moat, the thesis of the business all looks intact, but because of a very, very narrow miss, and some could actually argue going into this earnings, analysts did raise their guidance towards the upper echelon of what they were anticipating. I do not feel a business which misses on their earnings by 20 million, bear in mind this is a $100 billion plus business, should warrant a $36 billion wipe off of its market cap. And for that reason, as a value / asymmetrical investor, I do think there is a very good valuation here and there is a valuation disconnect. And in my personal opinions, I do think sooner or later the market will realise this. I think it could also look like a good swing trade for anyone who's looking at getting in short term, holding this for a few months and making a good return on investment after the stock goes up. And overall, I think this is at a very good valuation. I've done a discounted cash flow with a 15% margin of safety and I came to a fair intrinsic value of around $420. And like I just said, the stock is trading at $310 today. Going on to stock number 2 is Adobe, one of the businesses that have been massively sold off during the SaaS sell-off. And again, fundamentally and financially, nothing has changed with the business. But like most software stocks, there seems to be a stigma, a narrative, a sentiment in regards to AI. AI is going to come in, it's going to destroy Microsoft, it's going to destroy ServiceNow, it's going to destroy Salesforce, until it doesn't, until these businesses put out incredible earnings. And then the people who are selling these stocks because of stigma are now the same people buying these businesses much higher. And the reality is Adobe is an incredible business. This is one of the legacy businesses of software, the founders of PDF files, a very, very interesting business to say the least. And the valuations look compelling, a price to earnings of 16. Historically, tech stocks generally trade at a P/E ratio of 25. That is what's deemed 25 to 30, sort of what's deemed as somewhat fair value. You're getting it at 16 here, and you're getting a forward to earnings of 10, a PEG ratio of 0.75, and free cash flow per share of 40%. The numbers are looking compelling in this case. The numbers are looking good. The financials are looking good. I think the moat is somewhat still defensible, even though I appreciate there is some narrative and stigma out there about the AI trade taking over software and SaaS in general, until it doesn't. And something is telling me, just like we saw with Salesforce, which got completely beaten down to even 150, 140 at some point, now back at 240, we are going to see exactly the same with Adobe. And I think the people that wish they had an opportunity watching this video now will be the same people regretting not buying in a month or so when they come to their earnings. And stock number 3, moving away from software, is a business I'm just very passionate about, and that's Hims and Hers Healthcare. Let's use a little bit of common sense here, okay? This is a business that has consistently raised their guidance for 5 quarters in a row. This is a business by the end of this year, at the very minimum, will make $3.1 billion in revenue, yet they are sitting at a market cap of just $7 billion. Anyone watching this video who knows how to value fair intrinsic market caps of businesses know we use 5 different multiples. We use a multiple of 2 if we're bearish, a multiple of 3 if we're cautious, a multiple of 4 if we're average, a multiple of 5 if we're bullish, a multiple of 6 if we are very bullish. So even if we are cautious and we want to imply a multiple of 3 on this business, that is $3.1 billion times 3 to come up with a fair intrinsic market cap, takes us to an analyzed consensus of $9.3 billion. How much is the market cap right now? $7 billion. And if we use a multiple of 4, because I would say we don't need to be too bullish, but we don't need to be too bearish on the business, even though I'd love to use a multiple of 5 because we've got TB500s, BPC 157s potentially being announced as late as October, as early as October. We've got compounding peptides, we've got lots of acquisitions, we've got revenue massively growing, subscriber growth growing, value per customer growing, everything, guidance is growing and being raised. I would argue with a multiple of 4, and if we use a multiple of 4, well, that takes us to a fair intrinsic market cap of 12.4 billion. And like I just said, the stock is trading at 7 billion, which means the stock is trading at around a price to sales of 2 to 1, which is cheap. But like I said, sooner or later, the market will figure it out and they'll be sitting here kicking themselves for not buying more shares. So like I said, at the end of the day, I think all these businesses look at very good, compelling valuations. I think AppLovin, Adobe and Hims, if you're long-term, look good. Could look like a lucrative swing trade, maybe if you're looking at sort of getting in on short-term momentum, given these stocks are beaten down. And I think the upside could be quite lucrative, at least in the next few months to come, more specifically in AppLovin and Adobe. As always, no financial advice is given. This is just my personal research. And let me know what you guys think, because I actually think AppLovin, Hims and Adobe are at really good valuations, but I appreciate some people very much disagree with me. As always, take care.